everyone, and welcome to the February 17th, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to get right into those hot button issues going on in the market, so let's get started. Let's start first with the AI decimation trade, is what I'm calling it. What you saw is over the past couple of months, and really kind of exacerbated over the last month, is the thought that artificial intelligence is real, it's here, and it's going to start destroying a few firms, or at least really reducing the value of some of these firms going forward. And especially the first component that was hit aggressively was in the software space. So you saw a lot of the software companies really starting to see a pretty dramatic decline in their overall market value based upon the thought. I think this kind of came out when Claude had their updated outlook where they came, or excuse me, their updated release, where they came out and provided some coding capabilities that if you prompt it properly, can kind of create a custom out of the box software solution for you. And I think there is some advantage to that. I think also what you started to see was software got hit first, and then you started to see the secondary wave of people saying, okay, who else could be hurt? You saw it in commercial real estate and a couple other companies where you just saw that, okay, this is proliferating to these folks now as well. And so from our side on this, I think there's always, when you have these thematic trades, especially these negative thematic trades, is they can snowball on themselves. And clearly we're seeing that right now, and it could continue to happen for a while here. But what you also see is usually there are some opportunities because things get irrational. I think artificial intelligence could have a negative influence on software companies. Absolutely. It's those companies that don't innovate or utilize artificial intelligence to make them more valuable that are susceptible to being the next Kodaks of the world, right? The issue that I have is that right now we're treating all software as the next Kodak, and I really have a hard time with that. So in my opinion, I think there's some opportunities to take advantage of within there. If you can be patient, understand that this negative thought in the artificial intelligence isn't going away. So the negative sentiment around it could last a little while. But I really think at these points, there's some interesting valuations and there's some interesting companies that I think could innovate to actually become beneficiaries of artificial intelligence while still maintaining some of those software margins that we've seen in the past. So stay tuned on that one. Turning to number two, we had Goldilocks economic reports. We had some economic reports last week. We had CPI or inflation, and we also had a jobs report. Why I called it Goldilocks is both of them were, they're not rock star numbers, but they're also not so negative that it changes the trajectory of what we think of the economy right now. So overall, the jobs number was better than expected, and CPI or inflation was lower than expected. Now, CPI is not controlled. They're not in the sweet spot of that 2% range. We're getting closer, but we're still elevated above that area. The jobs report was okay. It was led by healthcare, but it's not like it's showing dramatic rock star type of acceleration in jobs. So we were kind of in this space of is this going to make a trend? Are we seeing a new trend? Are we seeing deterioration? Are we seeing a rampantly rising inflation? I don't think either of those things happened from this report. But again, one point does not make a trend. We always have to kind of look at this in a continuum, if you will. Are things getting better or are things getting worse? And I think right now it shows that things aren't getting dramatically worse, but I wouldn't argue they're getting aggressively better at this point right now. The other thing that I saw as a result of those reports was that the Federal Reserve is now not considered to make any movements until June. So the highest probability for the next two meetings are to stay as is, where we are from interest rates right now for the Fed funds rate. And we've been saying that since the beginning of the year, is that we think we're in a period of stasis. And nothing in those economic reports told me that we're going to change that thesis anytime soon. It's really going to be incumbent upon the next Fed chairman, unless we start to see something dramatically different than where we are right now. It's really going to be incumbent on the next Fed chairman to answer those questions about what the rate trajectory looks like, especially since, again, a nominated governor from President Trump is probably going to be under some pressure to lower interest rates because that's what he has been touting for a very long period of time. So we'll see what comes of that as we go forward. But again, right now the biggest assumption is what we've been saying for the better part of the year is that we're probably in a hold period with regard to Fed rates right now. Turning to number 3, earnings are mostly done except their consumer. We got Walmart reporting this week. That's an important one to take a look at. And then we'll have some others like Home Depot reporting next week. But the earnings trajectory is largely done. We got over 75% have now reported in the S&P 500. And I won't belabor this point because I said it last week, but I'm going to say it again, is that the numbers look pretty good. I mean, it's really a good backdrop for the market right now to have double-digit earnings growth for the 5th consecutive quarter and estimated earnings growth to be growing again in 2026 at a double-digit rate. That's really good. Earnings growth, again, over longer periods of time, earnings growth is your best correlation to stock market performance. It's not on a year-to-year basis, though. You can't say, oh, I'm going to do 13% earnings growth. Well, the market should go up 13%. It doesn't work that way. But over longer periods of time, the more you're growing from that, the better the stock market tends to do. And in periods of stagnation or decline in earnings, that's when you start to see the market have a bit of a difficult time. So if we can have that backdrop, and again, I've been saying multiple times that I thought in January the numbers were going to start to come down a little bit. We've not seen that. So at least as of yet, we are not seeing that level of, transition back of the estimates coming down instead of going up. Right now, we've been largely flat to slightly up in those estimates, which is, again, a good thing, is saying that companies are out saying, yeah, the numbers you guys have are probably okay right now, and we feel pretty confident that we're going to do okay. Because if they weren't, if the companies were saying, well, I think your numbers might be a little bit too high, believe me, the sell side would be knocking those numbers down right alongside with them. So companies seem fairly confident at this point right now. Again, we'll see what the consumer companies hold. Walmart's been a phenomenal stock. It's been a growth, it's basically has a growth multiple now by far. I think it's its largest multiple, at least in the last 20 years. So there's a lot of expectation built in there, but also they've been executing so well. So we'll see if that trend continues this week. Turning to number 4, I took the day off. This is Tuesday, and I took the day off yesterday with my kids being home for President's Day. And so I thought I'd spit one interesting presidential fact at you. It turned back to George H.W. Bush in 1988, was trailing Michael Dukakis pretty significantly. Now, if you know your history, George Bush won. But what was interesting to me is during the time when he was significantly trailing, they were asking themselves, how do we kind of re-engage with the public? What can we do? And one of the ideas floated was for Clint Eastwood to be nominated as the vice president. James Baker said this, I think, in his memoir in 2011, that they at least floated the idea because he was a mayor. He was mayor of Carmel by the Sea, and he was a Republican. And they were like, well, what if we got Dirty Harry to be the vice president? It was pretty quickly, I think, eschewed. But I thought that was super interesting that at one point when they're down, the chips are down, they're like, well, should we just grab Dirty Harry and see if that gets our numbers going again? Interesting little factoid. I hope you all had a good President's Day. I thought that was fun. So that's it for me this week. Tune in next week where we'll have the next hot button topics. But until then, thank you very much and take care.